everyone, I'm Ekta Kandhari. I'm a part of the acquisitions team here at Strata. During our course of work, we come across different asset classes and different types of commercial real estate, and we thought it would be interesting for you to learn what are the different types of commercial real estate assets. So, let me quickly walk you through some of those. So before we begin with the types of commercial real estate, let's understand commercial real estate a little more. Many research firms in their research reports have highlighted a positive outlook towards commercial real estate in the coming year, primarily owing to its recovery from the pandemic. Further, commercial real estate has also gained traction in the recent past. While erstwhile a traditional investor with surplus funds would typically invest in residential real estate, however, due to raised awareness along with the area of investment options and avenues available with these investors, this mindset is slowly changing. Moving on to commercial real estate characteristics that distinguish it from other assets. The lease tenures for commercial real estate assets are typically longer, ranging from as low as 5 years to as high as 15 years. Further, they are a high cash flow generating asset, which also makes them easy to leverage. Growth drivers that make this asset attractive for an investor would be that it's a great source of passive income. It also helps investors to diversify their portfolio, and if planned carefully, also enables tax efficient returns. Now, why categorize commercial real estate? Each type of asset class within the commercial real estate segment has different characteristics, and it is important for an investor to understand these characteristics before making an informed decision. Why categorize commercial real estate? Each type of CRE has different characteristics, and it is important for an investor to know these characteristics so as to make an informed decision. The types of subclasses involved in commercial real estate include office spaces, which is your glass facade buildings typically occupied by office occupiers. Next is retail spaces, which would be your malls or high street standalone buildings like a West Side, a Zudio, etc. Moving on to industrial warehousing spaces, which is typically your manufacturing related units and ancillary setups, typically present in the outskirts of the city. Warehouses you will also find within the city, but in smaller sizes. Data centers are typically your networked computer servers, which are used for storage and distribution of data by large-scale sizable organizations. Next, you have hotels, hospitals, and schools, which form part of special asset classes under commercial real estate. Starting with office spaces, these can be small standalone buildings, skyscrapers, basically part of tech parks spanning across a few million square feet. Office spaces are typically classified as grade A, B, or C based on the building quality, the amenities provided in the building, the maintenance and upkeep of the building. A grade A office would feature modern amenities and is typically built to global standards. They generally have certifications from rating agencies like LEED, IGBC, etc. Let's look at some of the distinguishing characteristics of office spaces. Starting with average annual yield, it would typically range between 6.75 to 8%. This would vary on factors such as location of the building, the asset quality, the maintenance and upkeep, and factors like that. The average lease period would typically range between 5 to 10 years. The key driving factors for this would be the tenant taking up the space, the size of the space, the level of customization, investments made by the tenant, etc. The lock-in period typically for an office space would range between 3 to 5 years, which is the lock-in offered by the tenant, whereas the landlord in this scenario or the lessor will typically be locked in for the entire tenure. Again, the factors determining the lock-in period would also be similar to the lease period. A lease transaction size, when we talk about grade A assets, would range anywhere between as low as 20,000 to as high as in millions. The factors here again would be the location that the asset is being taken up in, the rentals, the cost of basically taking up the space, the intent of the space being taken up, whether it's for front office, whether it's for back office use, so on and so forth. Talking about key demand drivers for office spaces, one can look at IT and IT enabled service occupiers, companies like Capgemini, IBM. You have your BFSI companies, which are your large scale sizable banks, financial services companies, media firms, and in the recent past, one might have also observed several co-working players coming into light and taking up absorption in the office spaces sector. Starting with retail spaces, these spaces would include your standalone high street stores like your apparel stores, electronic stores, etc. You have restaurants, you have shopping malls, theaters. These would typically form part of your retail asset class as such, largely concentrated in major business and shopping districts across any city. Typically, anything that would attract a higher footfall. It could be a multi-tenanted asset, something like a mall setup, or it could be an individual store, as one might have observed, something like a Chroma or a Reliance Trends, something on those lines. Talking about the characteristics of retail spaces, the average lease period for a typical retail asset would generally range between 5 to 15 years. However, the tenants are slightly conservative in terms of giving lock ins in a retail setup. It would anywhere range between a 2 to 3 year period. The transaction size could be as low as 500 square feet. However, an average transaction size observed in the market would be anywhere between 2000 to 40,000 square feet. Your key demand drivers would be your branded apparels, electronics, cosmetics, F&B, and so on. Talking about industrial spaces, these spaces generally house large-scale manufacturing units and supporting facilities, generally located in the outskirts of the city and usually part of industrial clusters. Some of the prominent examples would be Hosur in Tamil Nadu, a Chakan in Pune, or something like a Bhiwandi in Mumbai. Major manufacturers such as automobiles, heavy industries, and electronics not only have large setups, but they also attract supporting industries into setting up operations next to them. Speaking of characteristics of these industrial spaces, the average annual yield for industrial spaces is among the highest, ranging anywhere between a 7.5 to 8.5%. Average lease periods would be anywhere between 10 to 15 years. Lock-ins are comparatively the highest owing to the highest level of customization involved in these assets. Average lease transaction sizes would be ranging anywhere between a 50,000 square feet to a 3 lakh square feet or a 0.3 million square feet. Key demand drivers would generally be automotive assembly lines, consumer goods, high-end manufacturing, and precision engineering firms. Next is your warehouses. These are large built-to-suit facilities that enable storage and transport of goods and materials. Other than niche in-city facilities, warehouses are found on the outskirts and are a part of larger warehousing industrial clusters. Types of warehouses can range from standard e-commerce facilities to more complex assets such as cold storage units, which would generally store your perishables, grain silos, which are bulk storage units utilized largely in agriculture, chemical tanks, and cold rooms, which is typically used by pharma companies or to store other such chemicals, etc. Speaking of characteristics for warehouses, they are not very different from industrial spaces except for the level of customization is relatively lower. The average annual yield one would look at would range anywhere between a 7.5 to 8.5%. The lease period would be between 10 to 12 years, slightly lower than industrial spaces. However, the lock-in period would range anywhere between a 5 to 8 years, which is in line with industrial setup. An average lease transaction size would range anywhere between a 50,000 square feet to a 0.3 million square feet or 3 lakh. Key demand drivers in warehouses would typically be your e-commerce, your FMCG and FMCD companies. However, in the recent past, 3PL players have also taken up significant space in the warehouse sector. Moving on to data centers. Data centers are special purpose buildings that house computers and telecommunications servers. These are crucial part of the global digital infrastructure. These are usually located in coastal cities closer to highest electricity points where they will be close to undersea internet cables and have uninterrupted electricity. Further, many data centers generally have a primary and a backup setup. The idea is to leave no scope for downtime. Data centers are a fast growing sector in CRE as we move towards a digital age. More so gained significant importance during the pandemic, where data centers and the digital sector in general was at its peak. Talking about the characteristics of data centers, the average annual yield would range anywhere between a 7 to 7.5%. Typically, again, a function of minimum guarantee and revenue share, similar to your retail assets. It is also important to note that these data centers are generally built to suit, involve high amounts of infrastructure investment. Real estate costs in comparison are minimal, and therefore many data centers prefer to own these facilities. Alternatively, they would generally engage with large sizable funds or graded developers in terms of leasing spaces from them. The average lease period one would expect would be anywhere between a 10 to 25 years. Owing to the high level of customization, the lock-ins are typically higher, ranging anywhere between a 10 to 15 years. The lease transaction size would be anywhere between a 50,000 square feet to a 0.3 million or say 3 lakh square feet. The demand drivers would be your cloud computing services, data storage, telecommunications, internet services, social media, of course, lately has gained so much traction. Key demand drivers would include your cloud computing services, data storage, telecommunications, internet services, and social media. Coming to the final category of assets would be your other special assets involved in commercial real estate, which could range from hotels, hospitals, schools, co-living, which could be your senior co-living, student housing, etc. Moving on to the last segment, we talk about the special assets which are increasingly becoming popular, which includes hotels, hospitals, schools, co-living facilities like your senior co-living, student housing, etc. Of course, other than the primary CRE assets, niche properties such as hotels, hospitals, schools, they can serve as viable investment options, especially owing to the asset-light model, which is increasingly becoming popular among these asset classes. Residential CRE assets such as student housing, co-living, senior living, etc. are also emerging asset types. Some of the general factors that would affect these CRE characteristics, when we talk about average yield, factors like the repo rates increase the yield expectation of the investors and can have an impact on the average yields. Location is another important factor which determines the average yield. For example, an asset located in a CBD market would probably be at the lower end of the average as compared to something that's in an upcoming market, simply because of the higher land values. Age of the building again strongly determines the yields. Any building as it ages, the yield expectation for that building will be higher. Moving on to lease and lock-in terms, these are typically determined by several factors. One of the major factors that impact the lease and lock-in terms would be the investments incurred by the tenants. A tenant that has incurred heavy investments in the facility would want to give higher lock-ins and secure themselves for the premises. Next is your building and market trends. This also varies for city to city based on the government norms, stamp duty implications, and factors like that. Further, the level of customization also plays an important role. The landlord would typically want a higher security in exchange for higher level of customizations requested by the tenant. Talking about the transaction size, this would typically depend on the location and the city that the space is taken up in. It also depends on the rental trends in the city and the use of the space. So basically, if a tenant were to look at a front office space, this would probably be located in a CBD district of a city and would be smaller in size versus a back office setup, which would ideally be located in the peripheral district and would be a larger sizable space. Thank you for watching the video, everyone. I hope this was helpful and it helps you make an informed decision. If you have any concerns or doubts, feel free to leave a comment below, or alternatively, you can reach out to our website at strataprof.com.